If you're tired of everyone telling you you should start investing but not ever telling you how to start investing, then this video is for you. I'm Nick, better known as Nick Talks Money on TikTok, Instagram, and of course, right here on YouTube. I graduated college with a degree in finance, hold the CFP and EA professional designations, and have been a practicing financial tax advisor for the past 4 years, which all basically goes to say I have a pretty good amount of experience with all things money, especially investing. This video will cover everything you need to know to go from someone with zero knowledge about investing or the stock market to someone who's a confident new investor with their own investment account and stock holdings. I'll cover what investing actually is, why you should care about investing, the different types of investment accounts, the different types of assets you can invest in, how your investments are taxed. I'll walk you through how to open up your own investment account both on the computer and on a mobile app. And finally, I'll show you how to buy your first stock. This won't be a short video, but I promise you'll walk away with a firm understanding of how investing works and how it can benefit you. But before we start learning, I post informative personal finance content like this every week. Make sure you subscribe and hit the post notification bell if you want to see more. And of course, smash the like button to help more people see this video. I remember it like it was yesterday. I was a brand new finance major ready to start my freshman year of college and learn everything I needed to make me a millionaire investor. But as my freshman year came to a close, I found it odd that I barely heard any mention of investing or even the stock market other than a handful of conversations with my friends outside of class. The same thing happened sophomore year. A lot was learned about corporate finance, marketing, and all the other fun business school stuff, but we didn't learn anything about investing. Finally, during my junior and senior years, 2 or 3 classes went over the investing basics, but that was it. What I'm getting at here is that even I, as a finance major at a big, well-respected university, was barely taught anything about investing. I'd have to imagine the other 149 majors offered by my school didn't touch on it at all. This is problematic because if you ever want to reach even a modicum of financial stability, let alone retire someday, you need to invest. More on this shortly. So what is investing? The official definition is that investing is the act of allocating resources, usually money, with the expectation of generating an income or a profit. You can invest in endeavors such as using money to start a business or in assets such as purchasing real estate in hopes of reselling it later at a higher price. Essentially, you're using your money to buy something that you believe will increase in value over time and or generate a stream of income, but there are no guarantees it will do either. If you're holding your money as physical cash, that's not investing because your money won't magically raise in value overnight. If you're holding your money in a bank account or standard savings account, that's not considered investing either, even if you're making 0.0001% interest on it every year. Investing can be done with many different asset classes like real estate, cryptocurrency, private businesses, etc. But today we're focusing on investing in the stock market. The stock market isn't something you invest in directly, it's the marketplace used to buy or sell different assets like stocks, index funds, mutual funds, bonds, or other financial instruments, all of which I'll explain in section 4, so don't worry if it sounds like I'm speaking a foreign language right now. You can think of the stock market like a much faster, more automated version of eBay. If you want to buy a stock, you access the stock market through a broker, which is much easier than it sounds. Select the stock you want to buy, which is being sold by another person, not the stock market itself, and enter your order. With real life eBay, you might need to wait a couple days for an auction to finish or for shipping, but with our stock market version, your order is generally filled within seconds of you clicking buy. To wrap this section up, investing means that you're buying something you believe will go up in value over time, and the stock market is an open marketplace where people can buy and sell things that they are invested in. Now that you know what investing is, let's give you some perspective on why you should care about it. First off, what's wrong with keeping all your money in your savings account? Isn't that the smart thing to do? It would be if it wasn't for our arch enemy, inflation. Inflation is the rate at which our currency is losing value every year. It's part of the reason why the average cost of a house in the US was $12,000 in 1960 compared to $224,000 today. So why does inflation exist? If you pay attention to the news over the past year, chances are you've heard something about the government printing more money. The more money that's circulating in the country, the less each individual dollar is worth. As more money is printed every year, the changes in the value start to become noticeable as companies raise prices on their goods and services. Inflation can actually be a good thing, which is why the government doesn't stop printing money. A moderate amount of inflation is actually good for economic growth, which is why the government aims to maintain an annual inflation rate of 2 to 3%. This is a very important number to keep in mind. If your money isn't earning you at least 3% every year, it's losing value. For example, if you had $1,000 sitting in a savings account that doesn't pay you any interest, after 1 year, it effectively loses 3% of its value and would only have the purchasing power of 970 present day dollars. After 20 years, it's essentially worth half of what it was originally. Let's look at a more comprehensive example. In the previous section, I briefly mentioned that if you ever want to retire, you need to invest. Let's break down why that is. Let's say you take home an average of $60,000 post-tax per year from ages 22 to 62, and you fall in line with the average US savings rate of 14%. So of that $60,000, you set aside $8,400 per year for future you. With that $8,400 in savings per year, you have 2 options. 1, save this money in a savings or checking account, or 2, invest this money. Can you guess where this is going? If you were to save $8,400 per year for 40 years, you'd have $336,000. But wait, with an average inflation rate of 3% per year, this would only equal $191,000 in today's dollars. I don't know many people who would feel comfortable retiring with a nest egg of $191K. But if you were to invest this money into the stock market and get an average annual return of 10%, which is the average over the past 100 years, you would have $4.1 million after 40 years. That wasn't a typo. You literally have $3.8 million more after 40 years as an investor than you would as a saver. Even if you say the returns of your index fund don't account for inflation and reduce the average annual return down to 7%, you'd have the equivalent of $1.8 million in today's dollars. Introducing a question with the most obvious answer of all time. Would you rather retire with $191,000 in the bank or $1.8 million? Before we explain what stocks and the other assets you can invest in through the stock market are, let's go over the accounts that you use to invest in them. Again, these are accounts, not investments. Think of them like a bank account that's connected to the stock market. You deposit money into them, and you can then use that money to invest in stocks that are held in your investment account. For example, here's a screenshot of one of my investment accounts. You can see my investable cash on the top line, followed by the investments I hold in the account. If I sell one of my investments, it gets converted to cash, and I can do 3 things with that cash. 1, nothing. I could just leave it in my investing account as a cash reserve. 2, I could use this cash to invest in other stocks. Or 3, I could transfer this money to my bank account and spend it. There are all kinds of accounts available to you, but you can break them down into 2 buckets: non-retirement accounts and retirement accounts. The best thing about these investing accounts is that they're 100% free to open. If anyone tries charging you to open one of these accounts, they're scamming you. The account I just showed you is a non-retirement account, and it's the type of account you should open no matter what. It's called a brokerage account, aka a taxable brokerage account or a non-retirement account. The name brokerage makes it seem a lot more complicated than it actually is. Like I described above, it's basically just a bank account that's connected to the stock market. Because they're not retirement accounts, there are very few restrictions that come with brokerage accounts. You can deposit money, buy and sell stocks, and withdraw money whenever you want. But the downside of it not being a retirement account is that there are 0 tax incentives for investing into a brokerage account. We'll cover taxes on stock sales later in the video, but as we'll see shortly, there are some major tax incentives for investing into a retirement account. Speaking of retirement accounts, let's go over the 2 main non-employer retirement accounts available to the average person. Each of these retirement accounts offers a tax incentive for contributing money into them, but they generally lock up your money until you reach age 59 and a half. If you spent any significant amount of time watching personal finance creators, you've certainly heard someone mention Roth IRA alongside other words like best investment account available. So what exactly is a Roth IRA? IRA stands for Individual Retirement Account. You open it and manage the investments yourself. It's not connected to your employer at all. You can contribute up to $6,000 in cash into it per year or $7,000 if you're age 50 plus. This cash can be invested in essentially the exact same stocks, index funds, etc. that you can invest in with a brokerage account. Roth designation means that you get no tax savings in the year you contribute money to the account, but your earnings grow tax-free and you withdraw everything in the account completely tax-free starting at age 59 and a half. So if you invested $300,000 of your own money into this account and it has grown to $1 million by the time you're age 59 and a half, you can withdraw this entire $1 million without paying any taxes. Not only can you withdraw earnings tax-free starting at age 59 and a half, you can withdraw your contributions at any point in time after the account has been open for 5 years without paying any taxes or penalties. This gives the account great flexibility. It can be used as a last resort emergency fund. Speaking of penalties, if you decide to withdraw your earnings before age 59 and a half, they're subject to income taxes plus a 10% penalty. Because you've already paid taxes on your contributions, you are never required to withdraw money from your Roth IRA. Because this account is so powerful, the government limits who can contribute to it. If you make over 140K as a single person or over 208K as a married couple, you're technically not allowed to contribute to a Roth IRA, though there are some workarounds I'll explain in future videos. Next up, we have the Roth IRA sibling, the traditional IRA. It shares many similarities with the Roth IRA. They have the same contribution limits, the same rule regarding age 59 and a half retirement distributions, and you can invest in all the same stuff. However, there are some key differences. Traditional IRAs give you a tax benefit today by letting you subtract your contribution amount from your current year's taxable income, but make you pay full ordinary income taxes on distributions after age 59 and a half. So if you contributed $6,000 this year and your total taxable income is $50,000, you subtract that $6,000 contribution from your total income and end up with $44,000 $60,000 in taxable income. This would save the average person between $1,500 and $3,000 in taxes per year. But if you withdraw any money before age 59 and a half, you're subject to full income taxes on that money plus that 10% penalty. And because you don't pay taxes on your contributions, the government requires that you start taking distributions from your traditional IRA every year starting at age 72 so they can finally collect taxes on this money. And there are no income limits if you don't have access to an employer-sponsored retirement plan like a 401k, but if you do, you must make under $76K per year if you're single or $125K as a married couple to contribute to a traditional IRA and receive the tax savings. Remember that $6,000 contribution limit I mentioned for both IRAs? This is your total contribution limit for all IRAs under your name. So you can't contribute $6,000 to a Roth IRA and $6,000 to a traditional IRA in the same year. If you wanted to go 50-50 between them, you need to contribute $3K to each for a total contribution of $6,000 among all of your IRAs for the year. As far as which one you should go with, that's really up to you. Would you rather save taxes today or save taxes tomorrow? Do you think your tax bracket today is lower or higher than what it will be in retirement? Do you think taxes as a whole will continue to rise over the next 20, 30, or 40 years, or will they go down? Because Roth IRAs are more flexible and because the government tends to increase tax rates over time, not decrease them, Roth IRAs are typically the more popular choice. Now that we know which accounts to open, it's time to learn what we can use them to buy. Let's start off with everyone's favorite, stocks. A stock is a very small share of ownership in a single company. For example, if you bought one share of Apple stock, you'd own 1/17 billionth of Apple. Stock prices move up and down based on the performance of their issuing company. So if Apple continues to grow and beats Wall Street's earnings expectations, its stock price will move up. But if Apple falls short of expectations, their earnings decrease, their stock price will also go down. It's also possible they simply meet expectations and their stock price will just stay flat. Speaking of stock price, don't compare companies based purely on their stock price. For example, don't immediately assume Amazon is a better company than Apple just because Amazon's stock price is $3,500 per share and Apple's is only $150. Stock price is based on how many shares the company has issued in relation to its total value, so it's likely that Apple simply has more shares issued than Amazon. But there is one caveat here. If a stock price is below $10, it probably belongs to a struggling company that is more likely than not to go bankrupt. Stocks are identified by ticker symbols, which is an abbreviation that is between 1 and 5 letters long. For example, Ford's ticker symbol is F, while Apple's ticker symbol is AAPL. If you Google these ticker symbols, a stock chart will be your first result. If you search these ticker symbols within your brokerage account, IRA, or whatever investment account you have, you will find the stock you're looking for. It's important to search using ticker symbols instead of the company name, as many companies have similar names, but each ticker symbol needs to be unique. By investing in an individual stock, you're making a bet that that specific company will outperform all the other investment choices available to you. It's a gamble because you don't know anything more about that stock than anybody else in the stock market, which means that theoretically, the stock should be perfectly priced based on expected future performance. Only 20% of professional investors can pick stocks well enough to beat the average return of the stock market as a whole in any given year. So the odds of you becoming the next Warren Buffett aren't great. Investing in an individual stock is a fairly high risk, high reward endeavor. The stock price could literally fall to zero if the company goes bankrupt, or you could be investing in the next Amazon, but you're likely to fall somewhere in between. If stocks seem too risky to you, or you don't have the time to research which stocks you should include in your portfolio, you can just invest in all of them. I know what you're thinking. No, you do not need to have Elon Musk type money to invest in every single stock. You just need to invest in an index fund. An index fund is a basket of stocks designed to mimic the composition and performance of a financial market index, like the S&P 500, which is a group of the largest 500 companies in the USA, or the total US stock market. An index fund provides broad market exposure and low operating expenses. Because of their low expenses, most index funds charge next to nothing in fees. Like we're talking 3 cents per year for every $100 you invest. By investing money between hundreds, if not thousands of different companies with an index fund, you're essentially taking away half the risk of investing. Investing is 50% business-specific risk and 50% market risk. Business-specific risk is the risk that the company you're investing in underperforms or gets beaten by its competition. If you're investing in hundreds of different companies, this doesn't really affect you at all because you own Tesla, for example, and all their competitors. Market risk is something like COVID that affects every company. It's really hard to avoid something like that. Index funds also have ticker symbols. For example, Vanguard's S&P 500 index is VFINX, and Vanguard's total US stock market index fund is VTSAX. However, you may not be able to find these exact funds if you don't invest through Vanguard.com, but there is a workaround. You can invest in index ETFs, which are essentially the same thing. Vanguard's S&P 500 index ETF is VOO, and its total US stock market index ETF is VTI. Index funds take the gambling and the work out of investing because the only bet you're making is that the US stock market will continue to increase on average over time. Historically, that's been a pretty good bet as the US stock market has appreciated at an average of 10% annually for over 100 years. And again, only 20% of professional investors can pick stocks well enough to beat the returns of something like the S&P 500. In other words, by simply investing in an S&P 500 index fund, you'll probably get a better return than 80% of Wall Street investors who are paid six figures to try to pick stocks. You can see why I personally have most of my own money invested in index funds. Next up, we have an investment I can't morally recommend to anybody. These are mutual funds. The idea of mutual funds sound great. Think of them like an index funds, but instead of passively tracking an index, there's a team of investment managers actively picking stocks trying to beat the market. All of this active management commands high fees. Mutual fund fees are usually 30 to 50 times higher than those charged by index funds. And remember how only 20% of professional investment managers beat the returns of the market each year? This includes mutual fund managers. You're overpaying for underperformance here, which can cost you a lot of money. If you invested 10K into an index fund with a fee of 0.03% and 10K into a mutual fund with a fee of 1.04%, here are the differences in fees paid over 10 years that they managed to achieve the same returns. $66 in fees over 10 years for an index fund compared to over $1,800 in fees for the mutual fund. Again, you overpay for underperformance. These funds still exist only because they are cash cows for the firms that offer them. The quickest way to spot a mutual fund is to look at the fund's fees or the expense ratio. If it's over 0.4%, it's probably a mutual fund, and that's even on the low end. Mutual funds can charge as much as 3 or 4% per year. I'm not saying all mutual funds are bad, but you have to be really careful if you're investing in them. And finally, we have fixed income, which broadly is basically what it sounds like. You put a certain amount of money into a fixed income investment for a set period of time or the term, you're guaranteed a payment of X dollars in interest, and you get your initial investment back at the end of the term. There are many different fixed income instruments. Let's go through the 4 most common. 1, bonds. They're issued by either the government or private corporations as a way to raise money. They can have terms between 1 and 30 years. 2, certificates of deposit or CDs. They're issued by banks and typically have higher interest rates than high yield savings accounts and are usually issued in 6-month maturity increments up to 5 years. 3, money market funds. They're technically fixed income, but they act like a cash account that pays you a bit higher interest than your bank would. And 4, fixed income ETFs. Yes, ETFs can contain fixed income instruments and are a great way to gain exposure to fixed income if you don't want to sift through hundreds of potential bond purchase options. Fixed income is a good place to put money that you know you'll need in a set amount of time, like for a house purchase fund, and you don't want to subject it to the risks of the stock market. But with today's low interest rate environment, you won't be making much money with these right now. And a short disclaimer, this is not intended to be investment advice, it's just my personal views on these different investment vehicles. Do your research, make your own decisions. I know taxes aren't the most fun thing to learn about, so I'll keep this section short and sweet. If you sell a stock for a profit that you've held for 1 year or less, you're subject to short-term capital gains tax rates up to 37% on the gain. So if you bought a stock for $100 and sold it for $150, that 37% tax rate would only apply to the $50 gain that you have, not the entire $150 in cash that you receive from the stock sale. If you sell a stock for a profit that you've held for over 1 year, you're subject to long-term capital gains tax rates up to 20% on the gain. In short, it pays to hold on to stocks for the long term. And note, these taxes only apply to brokerage accounts. If you make trades within an IRA, it's not taxed as long as you don't withdraw any of the money. But if you sell a stock for a gain within a brokerage account, it's always taxed, even if you leave that cash in the brokerage account or use it to buy another stock. Now for the other side of the coin, you do get a benefit if you sell a stock for a loss. Let's say you bought a stock for $100, but you only sold it for $50. This would generate a $50 loss for you that can be used to reduce your taxable investment gains. So if you have $200 in investment gains and this $50 loss, your taxable gains would only be $150. If you don't have any investment gains to offset, you can subtract up to $3,000 in losses per year against your total taxable income. So you're still losing money, but it hurts a little bit less because it decreases your tax bill. And don't worry about keeping track of all this. Your broker, the provider of your investment account, will keep track of everything and include it on a tax statement they send to you after the year ends. Time for the good stuff. Let's walk through how to open your own investing account. Since investing apps like Public and Robinhood have achieved massive popularity over the past couple years, I'll first show you how to open a Roth IRA the old-fashioned way on a computer, then I'll show you how to open a brokerage account on the investing app Public. Note, this is a guide for those who are 18 plus. If you're under age 18, you'll need a parent or guardian to co-sign on what's called a custodial account. If you Google custodial brokerage account followed by a broker's name, you shouldn't have any trouble finding one. Step 1, select a broker. First off, you need to decide where you want to open your Roth IRA. Since this is a retirement retirement account, you'll ideally be holding onto it for the next 30 or 40 plus years, if not longer. So you want to choose a reputable institution that is going to stand the test of time. On top of this, mobile-first investing apps like Public and Robinhood don't even offer IRAs just yet. They only offer brokerage accounts. Because of these factors, I'd recommend going with one of the big 3 discount brokers: Fidelity, Vanguard, or Schwab. These aren't web browser only companies though, each of them have their own investing apps. They're all essentially the same. 0 account fees, wide investment choices, etc. The only real difference is their formatting of their website. But there is one thing about Vanguard you need to keep in mind. You need $3,000 to make a minimum investment in one of their index funds. So if you don't have this amount of cash laying around, pick Fidelity or Schwab. I hold my Roth IRA through Fidelity, even though I mainly invest in Vanguard funds, and I've had 0 issues with them so far. So I'll be showing you how to open an account through Fidelity. A disclaimer, I'm not being paid by Fidelity or the other 2 brokers to promote them in this course. Well, step 1, we're going to Google Fidelity Roth IRA. You can see I've already Googled this in the past. And then it'll be, you can click on either of these first ones. I prefer not to click on ads for whatever reason. Go in there and then make it pretty straightforward. Click on this big orange Open a Roth IRA button. And then you have 2 choices here. You can either say, hey, I will choose and manage my own investments, or I'd like Fidelity to choose and manage my investments for me. Now, rule of thumb, no matter what broker it is, like I love Fidelity, I would never recommend that anybody chooses this option on the right. Because again, no matter which broker it is, they probably have a list of high fee mutual funds that they are just going to throw on new investors who have no idea what they're doing. And by clicking learn more on the right here, you are basically inviting them to do that and take a lot of money from you under the table. So we're going to click on the orange get started button right here. And then, are you already a Fidelity customer? Obviously, we're going to assume you're saying no here. It takes just a few minutes, like I was saying, pretty quick. And then click next. And now we're at this tell us about yourself page, so just fill in all of your personal information. Click next, and the one thing you're going to do after this is choose a default cash position. They're going to say like, hey, do you want to keep your cash in cash or you want to keep it in a money market fund? It's probably going to be called SPAXX or SPAX. Now, in normal times, I love SPAX because it's a money market fund, so it gives you higher interest than you'd be receiving just on regular cash, which interest on regular cash is 0. But in today's low interest rate environment, the fee charged by SPAX, which is 0.4%, is not even exceeded by the interest rate that SPAC provides you. So you're basically receiving negative money, the way I see it, by investing in SPACs. So I'd say just put your cash in Fcash right now, and then open your account, and boom, you have your very own Roth IRA. Now let's walk through how to open up a brokerage account on Public. Full disclaimer, I am partnered with Public and receive a small kickback when you sign up through my link, but I wouldn't work with them if I didn't genuinely love their platform. Okay, so just pull up your phone. Hopefully my video is already pulled up. Go to my description, scroll down, and go down to where I say invest with Public and get a free slice of stock, and go ahead and click that. And I'm not lying, if you sign up through the link in my bio as part of me getting a small kickback, you're also incentivized too, because you can get up to $1,000 in free stock if you sign up through my link and deposit at least $1 into your Public account. So outside of the marketing spiel there, let's go and click on download the Public app. And then since I already have it, it's obviously I just hit open. Going to load up Public, and then click on Get Started. Then hey, outside of my reward, you get a free $5 slice of any of these stocks you want. And this is on top of, again, that free stock you get from signing up through my link. So let's go ahead and say like, I don't know, SPY, S&P 500 index, great choice, yada, yada, yada. Then you're gonna enter your phone number, your username, then all the other personal information Fidelity had you enter, and we'll skip ahead to show me open the account. And then boom, you have your very own brokerage account. While we're here, let's walk through how to buy your first stock. So you pull up the Public app, you're gonna be on the home screen here, the kind of Twitter feed looking thing. Go down to the bottom right where it shows the person icon, click on that, and this will show your personal portfolio. And then it's pretty obvious here. You click on the big blue deposit button, and then it asks you how much money you want to deposit. And obviously you have to kind of connect your bank account before you put money into here. So complete that step if you haven't already, but my bank account's already linked. And let's do a different amount. You can literally invest in here with as little as $1, which is pretty nice. Hit continue, $1 will be deposited, and boom, there we go, deposit initiated. I mean, it's gonna take like 5 days for the money to actually get to your account, but hey, they let you trade with that money beforehand anyways, so we can immediately go in to start investing. And as it says there, instant cash unlocked. So to actually invest into a stock, let's go to the magnifying glass. Up in the Explorer, this is where we enter those ticker symbols that I was talking about earlier. So let's do like VTI is one of the ETFs I mentioned earlier, Vanguard's Total Stock Market Index ETF. Click on that. You'll see that one share of VTI is $236, almost $237. But again, you can invest in a slice of this for as little as $1. So let's go ahead and click on this blue invest button. It says like 25, 50, 100, whatever. Go to the 3 dots down there if you don't see your amount listed, and then enter whatever amount you want. In this case, we'll do $1. And before we hit next, there are these different trading options down here. So market buy, limit buy, stop buy, etc. I mean, especially if you're buying fractional shares like this, like we are right now, where you're not buying a full share, you're just gonna wanna do a market buy. This just means that you're buying at the current stock price or whatever the stock price is that is able to be filled. And let's say, like for example, if you wanna do a limit order, you could say like, hey, I don't wanna buy VTI unless it falls to $230. And if it ever does fall into $230, then my order would automatically fill and I'd buy however many shares of stock for $230. But again, I don't really enjoy market timing. I don't think it's the right way to go about things. So let's keep things easy and go with market buy. Hit next. And it says, yes, I want to invest. You're going to get like 0.00422 shares. Submit. And boom. Congratulations. You're the proud owner of a brand new stock. And there you have it. You now have 2 investing accounts open and are the proud owner of a brand new stock. If you're in your 20s and invest at least $200 per month into the stock market, it's very likely you'll retire as a millionaire. This video is just the tip of the personal finance iceberg. If you want a comprehensive lesson on every money topic I believe the average person should know, take 25% off my full personal finance course linked in the description with promo code INVEST25. If you just want to learn more about investing, which there is a lot more to learn, you can take 25% off my investing course with the same promo code INVEST25. Want to learn more about money every week? Make sure you subscribe and hit that post notification bell. And of course, remember to smash the like button to help grow the channel. Appreciate you guys.